You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Jerry Parker, Moritz Siebert, and I, Niels Kostrup-Larsen, are back with this week's edition of the Systematic Investor Series, where each week we focus on helping you build safer and better performing portfolios by including trend following in the mix, and where we do our very best to answer all of your questions. Good afternoon, Moritz. Good morning to you, Jerry. It's the reason I say this is in a funny way is because we're recording this on a Friday, which is unusual for us. So I got suddenly a little bit confused what time it was where you guys are.
Evening here in Austria.
Yeah.
2 Eastern here, so
exactly.
Wide awake, not having to rely upon the coffee as usual.
Good stuff. I don't know about you guys, but maybe it's just because we're sort of end of a long week, end of the day. But it feels like it's been a pretty busy week, in terms of news flow. I don't know. Perhaps it's the chatter and noise we get around the Fed this week and what it's likely to do next, and how much the short-term bills are pricing in terms of rate cuts now. Of course, the huge amount of global bonds that are now yielding negative interest rates. And also, I think the fear is beginning to show in terms of, is the Fed really heading in the same direction as the ECB and BOJ with negative interest rates? And frankly, what does that mean to investors where they're going to search for the yield and returns? And of course, the three of us, we have a good suggestion for those who are looking. But in all seriousness, I actually think that trend following could be one of few kind of alternative strategies that will do really well in such an extreme environment, at least on the road to this extreme, if that happens. But only time will tell. We'll see in the next few years. And maybe this is the period where we have to produce the above average returns that we haven't seen in the last few years. So with all of that in mind, Moritz, you're in Austria. It's Friday evening. How was your week?
Markets have almost closed. Yeah, it's been a busy week, I must say. Lots of action in the markets. Interesting week. Up about 1%, so that's good. Coming from the bonds, most of it coming from a long gold position, which actually performed tremendously well this week. I think we moved up from 1320, reaching an all-time or reaching a new high of 1400 intraday today even. So that position is quite nice to have on at the moment long. Some givebacks in crude oil, given the news on Iran. So I had a short position on there, still short. Reduced that short position a bit, but the last 2 days cost some money there. I've mentioned the bonds. I mean, it's kind of like the gift that keeps on giving every week. I'm almost waiting for the thing to turn, but it's like a steamroller, just bonds moving higher and higher and higher. So that makes money, and currencies, well, chopping around. But all in all, a good percent for the week. So I'm happy about that.
Yeah, that's pretty good. Before I jump into how it all panned out for us, I wanted to just mention a quote. So completely unstructured today, really, in my approach here. But we get these weekly updates from our good friend George, and this week he sent us this update that starts with a quote. That goes something like this. Most traders miss the point of having a strategy with rules. It's not to find a magical method that works all the time. It's about operating within a certain framework so you know what to expect, good and bad, and how to respond. It's about establishing a circle of competence. And it's apparently a quote from a guy called Mark Minervini, I think is the name. So I thought that was pretty nice. But back to this week's action. It's been an up week for us as well. Not entirely sure where it's going to finish, but I think it's definitely going to finish in the black. Nice to see that some other markets are pulling their weight, especially in a week where definitely oil was a bit of a challenge, but gold, as you mentioned, Moritz. Of course, bonds, maybe not today, but certainly this week has been another one of those weeks where you saw bonds chip in. and of course with equities making new all-time highs. And although I would say overall our exposure to equities is not nearly as high as it was last time we made new all-time highs, this obviously is still helping. Reductions in the ags, of course, with the continued surge in many of the agricultural markets. So that's also been a challenge, a difficult one, but luckily there's been other things in the portfolio that seems to be working really well. So an interesting week on many fronts, lots of market movements as well. I mean, crude up 9.6% for the week. A lot of the oil markets up almost similar amounts. And on the downside, I mean, nat gas down 8.2% for the week so far. The hogs are down almost 4.5%. The dollar giving back some money, and that's obviously not good for many trend followers, including ourselves. So yeah, I mean, busy, I would say. What about you, Jerry?
Well, it's good week, good month. May was bad. I do have a material commitment to the single stocks long, mostly. They're mostly in an uptrend. But so it reversed in June, so that's nice. I was able to stay in those stocks, and they're doing pretty well. Fund gold, I think I try not to come across, most of the time I'm hedging myself when it may not sound like it, but I'm trying to hedge myself when I have these strong opinions, quote unquote, because they're not that strong. And I'm trying to not get caught in what I know happens, which is whenever you think something is a relationship or something is set in stone, it's going to change. And even though I have said many times crude, platinum, and silver are correlated, I've also tried to say, and then sometimes they're not. Silver doubled in silver went up a lot. I don't know if it doubled, but it went up a lot in 1987, and gold kind of sat there. And so we're seeing the same thing with platinum and silver not doing too much, and then gold doing a lot. So that was a fun trade to get on and be on, and hopefully that's a good sign or something, a good trend. And then I really enjoy being long Bitcoin for a week, and I had like a $900 profit 24 hours later. So it's just really funny that sometimes things like that do work out for you. So whatever's going on in the world, I don't have any idea, but it's kind of fun to watch those two markets go.
I'm glad you mentioned that. I forgot my favorite, the Bitcoin, the new Bitcoin. I mean, yeah, that's definitely been a good 25 basis points this year.
So you're both trading
out of one position.
So you're both trading crypto now?
Yeah, there's no reason not to. I read an article today that said as soon as the CBOE decided to shut down their contract, the CMEs got record volume, record open interest. So, I mean, there's no reason not to. Over the years, I've added so many markets just barely over the threshold of being what I would consider to be liquid. So no reason to discriminate against. Like I said a few weeks ago, I was so disappointed Moritz beat me to it.
Yeah, it's moving high. I mean, that's a hell of a trend at the moment.
Yeah.
But, we've seen this thing turn around in no time. I mean, you wouldn't be surprised to see it trading at 8,000 on Monday. I mean, this just can't happen. No,
and then, the ATR is large, so it's appropriately sized. Back in the day in 1994, I made 15% for the year and 15% in coffee. And my largest client called me up and said, why am I flat for the year and all your other clients made 15%? And I said, you don't trade coffee. And they said, well, we thought commodities were too volatile. I'm like, yeah, but we sized them inversely to the ATR. Oh, okay. Then trade commodities for me. Yeah. So that's the same thing. This, the margin is, I think our broker said the margin is 150% of what the CME requires. So even these brokerage firms and FCMs, they don't really understand. I mean, look, what's the wildest market we've seen in a month? Corn. Yeah. Oh, okay. Didn't know corn could be worse than Bitcoin. Yeah, of course it can. All of them can have some crazy action. It has nothing to do with, Bitcoin's a little unique, but I'm glad to be
it's just generally volatile. I mean, lean
Sure.
hogs went up 75% earlier this year in 1 month. So I agree with you. I mean, it's not really that radical. But it's also, of course, the way it's being portrayed by the press and so on and so forth. So, yeah, I mean, good for you guys. I'm sure that it won't be just around the corner for us to jump into that market, but I will follow your entry with a lot of interest for sure. Let's just before we jump into the tweets. I think the tweets have been good this week, but I do want to just remind people, those of you who have raised your hand very kindly about the live event we're planning in New York. I mean, we would love to wrap up the allocation of seats, etc., etc. There's still room, but we need people to who have raised their hand. We need people now to take the next step and confirm their interest, so we know if we're going to be 8, 10, 12 people, not more than that. So if you wouldn't mind, let us know as soon as you can. All right, back to the regular program, as they say. Tweets this week, Jerry, any particular themes or any particular things that just caught people's attention?
There were some themes. I don't remember what they were, but I will in a second once I start reading some of them. I did something different this week. I get a lot of I have a handful of friends in the trading world, including you two guys, but these other guys, they send me lots of information, and we discuss the markets throughout the week. And George, of course, is our good friend who summarizes what we talk about and sends us a lot of good information. And we've hung out together. And I just started saying, I'm going to start copy pasting some of George's emails, some of his sentences that he puts in his emails. They're really good, and people love them. It's like the most popular ones I've had this week, just off the top of his head. He and I are discussing things, and rather than copy pasting from some article, I'm getting a lot of good stuff from my friends. So the first one, which was the most popular tweet of the week, he says, in studying successful traders, the word consistency pops up a lot. And I think George does actually study traders. They don't change their spots all the time. It's best to develop a relatively simple, robust model that will survive various future realities, waiting for the luck to find you. And whenever I hear something I've never heard before, I really like it. And so waiting for the luck to find you. I don't even know if I know exactly what he meant by that, but it seemed kind of interesting that, I think that these systems that we trade, you've got to follow them. The entry is connected to the exit. Your entry does me no good with my exit. Your better entry or exit than mine does me no good unless I know both the entry and the exit. And it is a waiting game for our parameters or our style to kind of kick in and get our fair share at the right time. That's why discipline is so important. It's really almost a zig and zagging. I changed, or my system didn't work in May, but it's working great in June. And my time, my parameters are kind of, they will kick in. You will get your day in the sun, but you can't switch too often. And I think maybe that's what he means. He's waiting for the luck to find you. And what you need to do is just be there all the time. So when luck shows up, you haven't gone missing. And you will go missing if you make a lot of changes or you're not consistently applying your entry and your exit.
I love that. I mean, I think that's very good. And I think generally speaking, I think luck in itself plays a much larger role than many people will admit to. But what I really like about it is the fact that we actually, on our side, we did a study earlier this year as a consequence of a very difficult 2018 for our industry. Because we wanted to try and understand what could be the cause of such a difficult environment for trend followers. So we looked at a trend following methodology very close to our own, but we looked at different look back periods. So basically from say 20 days all the way up to almost 300 days, just to see how the distribution of which ones would be best each year over the past 28 years. I think we went back to 1990. And actually, I mean, it's surprising to see how much it changes from year to year. I mean, one year it can be 28 days, the next year it's 240 days. That's the best. So I like what you're saying about, or what George is saying about, when the luck finds you, because right, I mean, we can't change our parameter combinations every year because we don't know what they're going to be anyways. We have no idea. So we need to find some level where we want to be, where we're comfortable. And then obviously from time to time, that's going to be exactly where you want to be. And then I think that's how I interpret what you said about when luck finds you, you just got those things right and everything is aligned and you have a great year.
I really like that. And I think one of the most important things I heard there is that you do not have to go missing. You have to stay at the table and continue to play. I think this is one of the core problems for many investors is they give up on things and they may like trend following for a couple of years and then they stop using it. We all know that we cannot force our luck. It shows up when it is there, but you have to be there to take advantage of the opportunity. I just want to mention the experiment. Probably you guys know that too. It was, done by Tom Basso, the random entry experiment. Have you heard about that?
No.
So he used a trend following system and he says, well, the exit is important. We know the entry is important too, because if you don't make the entry, you're not in a position. But what he wanted to show, and I think he succeeded to show, is that risk management and sizing of positions and having stop losses and, not letting losses go unlimited, this is really important. So he was using an experiment. I'm happy to show you guys the paper and send you the link after the podcast. Where he did random entries, right? So kind of like coin flip entries, but he then let them run and he's using trend following methodology. If the trend develops, he's got a trading stop following that all the way through. If it goes into a loss, he stops it out. And this worked, right? But what it shows is that you have to be there when it happens. And this is, we may be going through 2 or 3 years of difficult times, but who knows what happens in the next 3 months. Maybe good for us.
And I'm not even sure luck is the word. I mean, I don't have a problem with luck, but it may be more of a randomness or just distribution. It's whatever is happening. It's not a consistent thing in the world, or what works is not always going to work all the time, but just waiting for your parameters to kind of be smiled upon, and they will be. And so that's the danger of making too many changes. We want to evolve. We understand the markets are different, I guess, and then maybe we have to change. Trend following adapts and changes to the fundamentals, but does trend following itself have to adapt and change to market participants? I guess it does, but too much change is costly.
Yeah,
I agree.
Yeah, definitely. Okay, well, that's a great start in terms of tweets and all of that. What else showed up in the
I'll go down the list of most popular. So the next one was, and since I wasn't here last week, I've 2 weeks worth, so.
Sure, that's even better.
Yeah. So my friend Mark, who I read all the time, and he is very smart. I'm picking on him a little bit, I guess, because I sort of nitpicked one of his posts on his blog, but it's the title of it is, "Are Momentum Models Better Than Moving Average Models?" And he sort of left out the fact that I like breakout models. Momentum is this academic approach, looking at the returns over the past X amount of months, usually 12 months, and the ones that are the positive or the most positive, you would go long, and the shorts would be the opposite. So, but I was trying to put forth, the breakout methodology as something that's preferred. And my comment was, don't forget breakouts. Breakouts don't lock in profits as fast as moving averages, so that makes them harder to do and probably better. So I don't know. Haven't looked at charts for 35 years. I've tried to use moving averages. I hear about them. I'm sure they're kind of similar, but I really like that feature that human beings want to lock in those profits. And that moving average moves up every day as the market trends higher and higher. And you pat yourself on the back because you just can't wait to lock it in and take a profit. but the breakout just does this stair-step approach, and it's something rallies big, like gold yesterday. That rally in gold for over $35 had the trailing stop with a breakout trailing stop did not move up one bit. It's kind of a bummer, but I think things like that are worth realizing and trying to make your system harder to like and harder to do.
I mean, I like that, and I wonder if someone has ever done a proper analysis of these three methodologies, which are probably the most common in our space. I don't know. I'm not really that familiar with moving average strategies, although I'm, from memory at least, I think certainly that's how some of the European managers started off. I think the US industry really came from the breakout. I mean, I think that's something that really is from the 70s and 80s, very much how many CTAs in the US started off, including ourselves. I mean, that's how our founder started off. But I think the Europeans were much quicker to adapt the moving averages, and then the time series momentum became kind of the next big thing. So on our side, we use the breakout and the time series momentum. Well, we don't use any moving average strategies, not as a specific signal generation signal. We might use it as a filter, but not as a signal generation.
Same here. You know what? There's also another one. There's a fourth one, and there's a paper that examines that also, which is regressions. And so, you kind of like you fit a regression line on the price, and that determines the trend, whether it's up or down, and then you take a position accordingly. And there's only one fund, which I'm not going to mention now, but there's one fund which I know that's trading that. But when I look at the performance of that fund, it's kind of like 0.8 correlation to a breakout strategy, right? So it's at the end of the day, those things are, for longer term trends, they're getting us in the same positions, right? Whether the sizing is the same, we don't know that. The timing might be slightly off. One set of those strategies gets you in quicker, the other one gets you out quicker. Who knows? I think at the end of the day, it's a matter of taste. I'm a big fan of the breakouts. There's some emotion in there where the price reaches a new high, people want to buy it. Okay, let's do it, right? This is nothing that a moving average gives me in the same way.
That's right. It kind of rubs me the wrong way not to buy the high, and not to sell the low.
Right.
So I kind of don't like that idea. And honestly, I thought about this, and I think, 1984, January of 84, I'm given a chart book, and I have to commodity perspective. We got them every Monday morning, and we filled them in with pencil or whatever pen for the rest of the week. And the high, low, close, and then. So I've thought about that, and I think probably more than anything, given technology and stuff, it's just not possible to calculate by hand a moving average, versus you could just count across how many days higher it was on the chart book. So I think that was probably the reason breakouts were preferred, because you can't, you need a spreadsheet to calculate the moving average, or you can't just do it with a chart book. So it's kind of funny. I think that's how it kind of stumbled into it.
And in a sense, and I think that's also part of what you're saying, Jerry, is that, I mean, it's certainly easier visually to see the breakout, for sure, where that occurs. And I think sometimes these things actually play a big role. What we can easily see is often what we prefer.
It's interesting, right? That what you say is true. I agree with that. It's visually easy to see the breakout. That market has made a new high or it has made a new low. But when you look at a historical time series, say for the past 5 years, and there's a 200-day moving average, you kind of feel like, well, that was easy, right? There's a 200-day moving average here. There's the price there. It's crossing here up and down. And it's very easy to visualize that one. Whereas you look back on a 5-year chart of daily bars, it's more difficult to find the new breakouts, because you don't know what time space you're looking at. Are you looking at a 20-day breakout or 50-day breakout or a 200-day breakout? So that is more difficult to see then. It's more easy to see in real time, I find. But, looking back on things, the moving average is just so convenient.
Yeah, no, very true. What else of goodies do you have in your Twitter bag?
Well, once again, let's go back to George. He had quite a few good ones this week. At least I liked them, and got a lot of responses. So another one I tweeted, He was statistical measures of risk have potential to lull one into a false sense of security that will leave you sticking with a loser. I view risk in archaic terms deliberately. Anything can happen. There are two ways to manage risk: stop losses or limited exposures, or both. So yeah, I think that trend following kind of wants to rely upon this whole idea, and we definitely rely and believe in this idea that anything can happen, good or bad. So we like the good stuff, and it can go for forever. It can keep going. It can be really. It can go negative. We can have negative rates. No, we can't. Yeah, I think we might. So let's just go with that. And stop losses or limiting your losses are very important, and because you can get hurt if you let a loss devastate your portfolio. And I guess he leaves out something I would have added: massive diversification. Not only currencies, commodities, stocks, bonds, but long and short those sectors and markets. So I think that CTAs are probably one of the better groups at being humble when it comes to risk and not being able to. Later, he mentions the limitations of some traditional statistical measurements, VAR, and things like that give you an indication that risk is low or high, but not a really good indication of what is possible in the future.
Mart, any thoughts on this particular topic?
Oh, agree on all of that, but it was so long. But yeah, I mean, to the point I'm just looking at, some of Jerry's tweets for the past 2 weeks because I haven't been all too active on them. But there's one that relates to what you just said on the negative rates. There's a chart that you send around, or a graphic that you send around on forecasts on the 10-year yield. I think at the beginning of the year or whatever that was. And there's not a single forecast that is even in the proximity of where the 10-year yield is right now. So I mean, to me, this is kind of like this is like a pot of gold, because once again, those, as Jerry uses to say, the fundamentals. I mean, all this forecasting of, I know this is going to happen and the yield is going to be there and it definitely needs to go higher, blah, 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 really. I mean, just follow the price. The thing is doing whatever it's doing. And you really have to avoid getting trapped into your own opinion of where that should be. So I always love those type of things where, people, they have their strong opinions on wherever things need to go, but then it's, it just turns out to be absolutely wrong.
Same thing happens when journalists start to make predictions about where trend followers are going.
I hope so. Yeah, I hope so.
I suddenly remember the ones we discussed around March 1 when Bloomberg came out with the how there is no way trend followers could work because now we have Trump tweeting and everything goes so quick, and for sure that meant that these strategies would be failing. And ever since we're pretty much extinction, ever since it's just been on a tear. So it's, very human to do these things, I guess.
We speak about that all the time. Of course, the three of us, we speak about it all the time. There's many more people that, have the same view on, those forecasts really aren't worth anything, or at least not a lot. But there's to no avail. It just recurs and recurs, happens over and over again, because that's the media that needs to write whatever it is, something, anything, right? So I'm not sure what's really driving them, whether they have a strong opinion or whether it's just that, something needs to be sold, some news story needs to be sold, and they just put it out there and, see what happens. If it sticks to the wall, if they're right, then, they can congratulate themselves and tap themselves on the shoulder. And if it doesn't turn out to be right, there's not really a corrective factor that tracks them down and says, well, there's no penalty for being wrong, right? You just forget about it. So it just, that's the way that thing works.
Yeah, my friend John sent that article. He wrote this piece about included the part about the Wall Street Journal economist. That chart is quite amazing. It's easy to make fun of people who predict because we know they're going to be wrong. And somehow I try to always say, the trend following is wrong 60% of the time. So we're not good at predicting. And Twitter, there's another good tweet I'll get to that Bill Eckhart talks about predicting as well. But The main part about the article was that studies show that the main driver for persistence of predictions is the desire to feel control over our fate. Our fear of uncertainty is a powerful force. And we can understand that people want to make the world make sense and get a collective group of people together so we all understand it makes sense. And when we all lose, we'll feel a lot better. But my response to that was systematic trading decreases our feeling of being in control. If it's done correctly, the system is kind of in control. And that's like the worst feeling ever. There's nothing more terrifying, I think, in trading and finance than putting your fate in the hands of rules. It could be AI, it can be trend following, simple spreadsheets, Excel, whatever. But it really is, what are you going to do today? Nothing. But we're getting our ass kicked. I know. I don't like it. And that's why, it makes me think of that. We've talked about this David Drew's quote where he says, you'll know that systems are robust if they have lots of volatility. Mm-hmm. Because what did you do for that volatility? Nothing. Why? The system said, wait to the 100-day low or the 200-day moving average before I exit. So what are you going to do before that? What if you give all this profit back? Nothing. I mean, it is bad. And I think the more some clients pick up on this could be one of the root problems of, they're like, oh, I understand it totally. I thought I could be patient. But you're asking me really to do the hardest thing possible, is to sit back, sit on my hands, and do nothing until, even worse, long-term systems say, now you can finally exit. It's bad, and it's bad. I've been thinking about how hard that is. Not so much for me now, because I've realized that trying to short circuit that is worse. You're going to miss out on profits. But it takes a long time to get to a place where you're really, really comfortable, at least for me.
I know, and I think this is actually true of any system. I think this is the algorithm version, whatever you want to call that, right? Having a system being in control of your fate, of your returns, taking over from your smart brains, right? This is not just for a systematic trend following system. This is, any type of quantitative trading system, be that mean reversion or whatever it is. If the thing stops working, if it doesn't give you instant gratification, instant satisfaction in terms of returns, if it has a longer term drawdown, if it feels uncomfortable, it's very easy to lose confidence in that system. And that's where I think the alpha is, to then stick with it and, go through that trough and come back out the other side. It may take some time, though.
I mean, of course, one of the quotes from our conversation last week with Corey, and I know we've talked about this before, is, if it isn't hard, it isn't alpha. Right. And I think that's true. I mean, another very simple analogy where we talk about how difficult it is to let systems take over. I don't know about you guys, but when you put your car on cruise control and you just wait for it to kind of stop, when you can see the car in front of you braking far before the car can, and it just feels a little bit, weird to wait for that long before it reacts. And of course, now we're moving into a world where we're talking about self-driving cars. I mean, can you imagine how uncomfortable it's going to be to sit on the back seat without a driver and just let it do its thing? I mean, I think it's going to be very hard for people to get comfortable with that. And the final thought I had when I heard what you said, Jerry, is that I think some people can be quite surprised about how transparent we as an industry have become. I know in the old days, and I certainly remember when your story came out, the turtle story, how it was very mystical, and everybody wanted to find out how are they doing it. It was not a lot of transparency back then. Today, I think there is a lot of transparency about how we do this, and when we talk to investors or potential investors, we are pretty transparent. Because the key thing is that when it's based on behavioral finance or human behavior, there's not a lot of secrets. But the secret and why the reason why not more people do this is not because it's difficult to figure out. It's because it's difficult to do. So you can share a lot because people are not going to raise their hand and say, oh yeah, I want to be a trend follower, because it's just so difficult to do day in, day out.
Yeah, I mean, alpha. What I'm interpreting is alpha equals. A lot of it is just sitting through the drawdown.
Mm.
I have a Tesla and I put my car on that auto drive.
Okay.
It's not the back seat; it's my wife in the front seat. That
Okay.
she's like screaming at me to take that thing off. But I think, and not to beat a dead horse, because I have my favorite topics, and this is another one. Unfortunately, I apologize, but I just think that from what I hear and read, and I know obviously, come on, give me a break. I'm not against money management and risk control, right? But I do think that the temptation is overwhelming for people to say, let's program it in. It's a rule, and then and call it money management and risk control. But wait a second, we have risk control. We're going to risk X number of ATRs, and we're going to lose 35 basis points of our bankroll of our equity, and we're fully diversified long and short. We have trailing stops. So why do we have to override the exit, the long-term exit, and call it money management and risk control? And I think this is a huge danger that is that people are prone to defend. And it's almost like, there's words in our societies these days. If you say the word, everyone needs to stop. You can go no further. You've been defeated intellectually. And I think money management and risk control are two of those concepts that, well, crap, I was waiting for the 100-day low, but if you got out near the high because of high vol. I mean, give me a break. This is just what I call systematic discretion, because you don't want to have alpha, which is sitting through drawdowns, and which basically is the reason we make money. But anyways, I'm ranting. Sorry.
No, it's fine. It's good. You have had it built up from not being here last week, so get it out. That's fine. What else? What else do you want to share with us, Jerry, from your side before we jump to some questions? I mean, funnily enough, a lot of what we're talking about right now, I already know that there's questions about that, so we may even come back to it a little bit. But I would love to hear what else you picked up.
Oh, yeah. Let me find the Bill Eckhart. That got a lot. That was an old article, and George was asking me questions, and I said, okay, I think some good ideas in this article from a few years ago.
And while you find it, by the way, Bill Eckhart, of course, was on a friendly podcast that we also like, AQR Series Season 2, had Bill on, and he was talking about trend following, of course. So nice to see that there is more discussions about this little strategy.
Oh, I didn't see that. I'm not on top of my game. So anyways, it's a great article. The man who launched 1,000 systems. I have a copy of it on my Twitter, but he says, superficially, it seems like trading is a form of prediction, but it really isn't. Designing the systems as trying to predict the markets doesn't work. You have to concentrate on projecting losses, risk management, and finding something that works. Estimators don't show every divergence from randomness. If a model says corn should go up 2 cents, but it goes up 8 cents, by the normal way of measuring, it was off by 6 cents. So it was a bad prediction. It was a good trade, but a bad prediction. I can begin to understand all of that, but I do think that's kind of funny. And, that's a really good way of looking at it. You can be, how could you think it was a good prediction if you're off so much? But, we ended up making lots of money.
Yeah.
And I think to some degree, we say that a lot in other ways. Like, I have no idea why Bitcoin's going up or gold went up, but I made a lot of money. So I think that's pretty fun. That's when we have our good fun.
Yeah, and it's all about not necessarily making the right decision, but it's making the accurate decision at the time, based on the data we have available. And in this, this is discussion we talked about when Annie Duke's book came out about, the various, ways you make decisions. And so anyways, not sure where I was going with that, but anyway. Moritz, any thoughts?
Definitely have to read that paper. I just downloaded while you guys spoke. It's in my mailbox now, so I'll read it after the podcast. always great
Okay.
to read things that Bill writes.
Sure.
Yep.
Absolutely. Anything else, Jerry? Or do you want to take a couple of questions? We can always come back.
Let's do questions.
Okay. The first one is one of the things we've certainly touched upon, I would say, before, but since it's from our good friend Sam, we definitely want to take this question. So it goes, another potential abstract topic, in so much that the trading/investing world, you hear the wise approach is to not over-optimize curve fit, but that you, bracket maybe, should do some optimization, whatever that means. It seems in trend following, we might only seek to optimize our risk parameters and nothing else. It might actually seem that we could seek to not optimize anything in any way to any degree. So in your collective views, please fill in, expand on this statement. My view and attitude towards optimization is. So thanks, Sam, for that question. Moritz?
There's a lot in there.
There's a lot in there, yeah, absolutely.
So he was saying we only optimize the risk management part of our systems. Did I get that right? But nothing else? I'm not 100% sure. I don't want to give the wrong answer.
No, I don't know if he's saying that, but I mean, maybe in some ways you could say that, but maybe I think the question is just more broadly, you know.
Well, to me, the thing is, you know, what is over-optimization? Over-optimization is you have instability in your system and it's no longer robust because of the fact that you've over-optimized it, right? And the cure, really the only cure against that is sample size. So if I have a large sample size that I can work with in the same way, you know, large sample size, I only get that if I run a system that's using the same signals, the same entries, the same exit rules for all the markets in the same way that I trade long or short, right? That gives me the large sample size. And on the back of that large sample size, I can find out whether I like that system, whether that system is robust or not. And then, of course, I mean, there are choices that I make. I don't think that's, you know, that you can say that's optimizing the system for my liking. It's not over optimizing it to only fit a historical time series and, you know, create nice historical returns. But I optimize it for my liking. And what I mean by that is, well, how much risk does it take? How much heat, how much volatility does it have? You know, what time frames do I trade? Is it more in the, you know, medium to longer term time frames, or is it in the shorter term time frames? You know, those type of things. Of course, I mean, this is optimized to my liking. And, you know, Jerry's system and Niels' system will look different because you like different things, I'm pretty sure, right? We like the same trend following type of thing, but maybe our risk view and risk tolerance is slightly different. So that is what I optimize for myself. And other than that, I try to be extremely careful to not over-optimize anything.
One of the things, and I think we touched upon this a little bit last week with Corey, and that is because he had also done some work on this, but I don't think this is anything that is surprising, and it's this balance between, you know, if you make something too simple, it can be fragile, even though we often say that if it's simple, it's more robust. So that's definitely one side of things. And of course, the other side is that if you make it too complicated, it can also, you know, make it fragile in a sense. And by complicated, I mean, again, I think if you try to be too clever about things, if you try to optimize, you know, you put yourself in a weaker spot. So I'm still of the belief that things should be, you know, relatively simple. I don't think what we do, when I look at what we do compared to what trend following did 20, 30 years ago, I definitely know that what we do is a lot more sophisticated in some ways, yet it is founded upon some principles that were also valid, you know, 20, 30, 40 years ago. We've just found maybe a little bit more, I wouldn't have used, I mean, sophisticated is not the right word, but we found better ways of expressing those core beliefs. And So I don't think there's anything wrong with trying to make things better, but you have to be really careful. And I certainly don't subscribe to the fact that things that are more complicated and sounds more fancy, etc., is better. I don't believe that. And I remember a quote from you, Moritz, a couple of weeks ago, where you said simplicity doesn't sell. And I think that is true. I mean, I think that's one of the problems for our industry. Not that I, really want a lot more trend followers raising a lot more money. I don't think that's going to help us. But our stories are usually not quite as sexy as some of these newer strategies that people tend to fall in love with. And maybe it's just because it's an old story that has been around for a long time that people just think, yeah, I've heard that before, and
Really, there's no objective definition of simple. It's in the eye of the observer. What's simple to you may be complex or sophisticated to somebody else looking at the same thing, right? People always say something is simple, but there's no definition as to what simple really is. To me, what it means is, I like the fact that, some of the things that we do, they can be sophisticated or even more complex, and there's nothing wrong with that. That can still be simple, but what it absolutely needs to produce is a large sample of trade statistics. And it's very clear that if you have a system that's using 10 or 20 parameters to get you into a trade, right, all the things need to line up and it needs to be a half moon day, then that can only work in the past. And, the sample size that you create with that type of system is very, very small. It's very unreliable. And it just so happens to be that, the fewer the rules, the fewer kind of like the drivers behind what gets you in and out of the trade. I'm not saying they're simple. They may be sophisticated in the way that we do it, right? But their applicability, they show up, quite often in a frequent way. And that gives us the sample size and the reliability for that system.
Yeah,
and
I think that, here's the bottom line. Trying to figure out a way that you can be long-term, which is necessary, because you need to figure out, the way I look at it is two different things. Two things you need to worry about. How do I get in the trade and not keep getting knocked out? These days, you have to be longer term than the 80s and 90s. Then how do I, if I'm going to do that, then great. But how do I, when the market turns around and I have this open profit, how do I not give back too much or all of it or enough to where my approach is not really that profitable anymore? So trying to come up with a sophisticated way to get out before that long-term exit, I don't know how to do that. And my guess is neither does anybody else, hardly anyone else. So if you want to tell me, oh, I'm very sophisticated, so-and-so is very sophisticated with lots of good techniques, we know when to override our system exit. I mean, to me, that's fraught with a lot of problems. I want to do it. I think I have some ways of doing it. I just don't think it's really math. I think that when we have these outlier trades, the trades that matter, and we make in 100 ATRs, 50 ATRs, 200 ATRs, I don't want to see it all go away. I've seen trades, it happens in the data. And so what are you going to do to override your 100-day low, your moving average, long-term moving average crossover? This is a problem. And so I'm a little skeptical of being more sophisticated when I know that's where you've got to go. Oh, maybe you went other places, which is great. Entries are better, whatever. But if you want to make a change, if you want to do something material, that's where you have to start looking. And I think that's difficult. And I don't know how to do it.
I actually think that one of the things that comes with experience in this industry, and I think one of the things that is the hardest thing that we do, is actually continuing to make what we do simpler in a sense. I mean, I think it's that is it's harder to take something complex and make it simple than vice versa. But I also think that it's to some degree, if you and maybe I'm not entirely sure how to phrase this, but if you take different investors with different skill sets or experience and you put them in front of a chart, I think they're all going to see different things, right? I mean, some people will see all sorts of patterns and head and shoulders and rising wedges and all of that. That's just how they see it. And I think we as trend followers, I think the better we get, the more experience we get, we just see the price. And we don't see all this noise and, complexity and so on and so forth. And I think that's something that you have to train yourself to do. Just like you said earlier, Jerry, you have to, only with, experience has it become easier for you to ride these drawdowns. I'm sure that's the same for all of us, certainly not just for you. So it's almost like, just see the markets for what they are and don't see them for more than what they really are. Sometimes that can be really hard, and I think it comes with experience. And then what we do is then we distill that into rules so that we just trade, quote unquote, the truth. I mean, we think the truth of the markets is the price. That's it. But I'm sure when you start out and when you look at these things, you see a lot more than just that.
Yeah, I mean, I don't think my systems have ever been this simple.
Yeah.
And I would look at these weekly charts and see, and if you look at weekly charts, you can see, 15 or 20 years worth of data on your screen, and you put a channel around it, you can see these monster trends pop out. You can see the material, what's a material trend? Your definition of that kind of changes. And so I would go to my research group and say, okay, let's try to trade longer term, and here are the parameters that I think, number one, doesn't knock you out too quickly, and it doesn't usually give back too much profit, but it does sometimes. So let's make that a separate project. We'll work on that. And they would run it through the computer and they'd say, yeah, you got the parameters pretty close just by eyeballing it, because it's not rocket science. What keeps you in a long-term trend that goes a year or two, but usually doesn't give back too much profit. But I'm not a big fan of people looking at charts, because it's just like you say, you'll see something, I'll see something. It's very brutal to take that same price data and throw it in a back test. And the computer is very rude at the results it'll give you. You think, some of these ideas I have might work, and then they don't work that well. So I think that's sort of the bottom line to me, is staying in gear with these long-term trends, but not staying around too long. And I saw that quote from Corey's podcast where too simple can equal fragile. And I was really wondering how that could be possible. And so I really don't know how that could be possible. A moving average crossover, reversing breakout, and that's all that there is, maybe with a stop loss. I mean, that seems pretty simple. I don't think it's fragile at all. I do think that maybe the word I would use is it might not be profitable. It may not be very good. So that's something that's sort of a given. Like, you can't be touting your system and how robust and not fragile it is, but it really doesn't make much money. So I could definitely see that.
Well, I know the next question is something that, especially you, Jerry, but you're not allowed to answer with one word, amen. But here goes. I would like to know what each of you think of the following. Since investing with a CTA provides a client diversification among a broad class instrument, why shouldn't a client invest the majority of his/her portfolio in one of these trend following systems? You often hear one should invest 5% in one asset, in one assets in this type of program. It's not read very eloquently, but I think we get the picture here. Basically, Mike is saying, if we're giving you all this diversification, why not put a much larger part of your portfolio into trend following?
Yeah, well, this reminds me a little bit about where the big discussion you and I had a few weeks ago. And so I'm just really concerned if I can get my point across and be clear, not that everyone has to agree, but so I was like trying to make the point that I don't like view what we do as managed futures as a category as much, and that's going to lead me to allocate a certain percentage to managed futures. That's not exactly the way I would look at it. I don't think that's correct. Although I think it's fine. If someone out there wants to allocate to me, that's fine. But I look at it and breaking it down between the different sectors and all the different markets, the currencies, commodities, stocks, and bonds. And this is massive diversification. It's the best. You can't get too much better. You can add Bitcoin. You can add some esoteric stocks that don't act like stocks. Great. You can access more diversification through ETFs or stocks or whatever over the counter. But by and large, you're not going to get more diversification, which I think is kind of the goal. And you throw in shorts and you throw in some risk control. And more importantly, the wrapping the trend following around each one of these markets turns it into a profitable market to trade, whereas analyzing these same markets, 100 markets or 100 different markets, based upon the buy and hold, you may say it doesn't work that well. So stocks were great, bonds are good. I'll include gold and some real estate, and you're stuck. And then how about the other 85 markets, cocoa, coffee, individual markets that we trade? And so it's hard to argue that this should not be the kind of core. And then if you wanted to say to yourself, it seems very illogical for me to think that it's safe and profitable to just own the S&P 500 index. Well, maybe I'll do that anyways, because there are times when that does outperform trend following in the whipsaw scenarios that we've seen recently. But then you've got to get over the idea that stocks are the center of the universe and they always make money. And when we may think that all of these other markets and sectors have the same profitability and possibilities as stocks. So the worst thing that could happen is what's happening now is the trend following of all of these different sectors and markets has really underperformed long-only stocks. So that's where we are right now. Philosophically and theoretically, I believe I make a very strong case, but practically, it just falls on deaf ears.
What about you, Moritz? Are you?
I'm 100% on Jerry's side there. You could have said it better anyway, really. But look, I mean, owning the S&P 500 long only buy and hold can be very risky. I think, in fact, I'd say it is very risky. It just doesn't feel like it in the last 10 years, and it doesn't look like it when you look at a 50-year chart, right? Then the thing looks like roses. But it's so difficult to hang on to the thing during the difficult times. And we may have just been so lucky that equities, U.S. equities in that example, have performed so well in the past couple of decades. But really, the point I want to make is, the systems with the risk control and robustness that kind of like give me the protection, and that is what I want. And I really want to expand here and say, it doesn't have to be 100% trend following. Absolutely love trend following. There are other systems which I like. I mean, there are systems which I do not like, which I would not trade, like systematic, say, selling of volatility. That's a system I do not like, right? But there are some systems which trade spreads, which I think are robust, by other managers, and I really like those guys. There are shorter term systems which I like. There are systems too. They're not necessarily trading trend only, but adding them to my portfolio is a great thing. But I know that the way those systems have been created, the way they're traded, the people that own them, that manage them, they have the same type of views. They have a robust system that has risk management, has all sorts of risk control around it, and that gives me a just good happy feeling when I put it into my portfolio. Much better than putting in long gold only.
Good stuff. I mean, there's nothing really I can add to that. You both said it very well. So let's jump back to another question. This is actually from Sam again, a little follow-up question. Let's see if I can get this a bit clearer. During December and early 2019, trend followers / CTAs were heavily scrutinized for not handling the fall crisis in U.S. equities well, getting out too late, getting back in too late. The bulk way I handle U.S. equities is to take a very long-term view to the majority of that allocation, 18-month look back. In that case, an exit short was never triggered. I stayed long. In my view, this is a textbook example for the industry to, one, promote long-term approaches with risk and diversification, and two, be firm with stating that this instance was nowhere near a crisis. It really wasn't that big of a down move, given the tremendous run-up over the past few years, if that is the horizon you take. I have no idea if your strategies would have stayed long in December, but this just feels like an opportunity to stand firm with the view that we are here to prevent real extreme downside. Or perhaps I'm insane as an individual investor myself for taking this 18-month stand view. Thank you again, Sam. Very interesting. Let me kick that one off since I didn't say much to the last question. We did get out of most equities. We did go short most equity markets in the fall of last year. So we certainly made some money from equities in December on the short side. Obviously gave back some of that in January, but got back on the long side, and have made money from the long side this year. So, I don't know if it has to be religious, that we have to be so long term that a situation like the fall of last year could not have triggered us to go short. But I'm not so sure if I kind of agree with you saying it wasn't a real crisis, but it could have become a crisis, I would say. If there hadn't been all those tweets and interventions, it could have been, I think, a somewhat more of a crisis than what we got. But what I do think is it was very different from what happened in February of last year. That 2-week event where trend followers really lost a lot of money, like so many other managers, not just from equities, but from all the trends that turned at the same time. To me, that was no near a crisis, even though the losses were more severe. It was a 2-week event, a little bit of a freak event with low liquidity and so on and so forth. But I still think that a lot of trend followers, would have gotten short some of the equities last December, and would have had to turn positions this year. What do you say, Jerry?
One of the best questions ever. I wrote down so many things to say. Man, Good. This is a great question. Maybe he's calling us to be even longer term. We always talk about, I talk with other traders and friends. I'm long term. I'm long term. I wonder how long term they really are. What is your definition? I think there's probably people out there who would think my definition of long term is like nutso. So he's saying maybe even longer term. I like that. That's interesting. I'm going to check that out. I'm going to take that challenge. But we have our colleagues in the CTA industry who are saying that long-term trend following is turn their back on the clients and their style drift. The mere fact that December was a temporary sell-off, that's disaster. Yes, and you should not let that happen. Makes no difference that it rallied. I don't care for that argument, of course. But I do think one of the most interesting things about this question is and I know exactly what you're talking about, Niels, as you described the stock trading. And that is, this is why it's so important to trade the single names, because what was going on in the indexes was far different than what was going on in a diverse group of equities. And so I think that's another thing that really is challenging, that we've got to think about getting more diversification, because those indexes were in a downtrend, but I'm sure the vast majority of my stock positions were long and remained long. So when it all rallied this year, I still had some of those positions. But I love your idea. You're almost giving me the impression like it wasn't a disaster. It wasn't that bad. It wasn't a crisis. It rallied. Exactly. Ignore those drawdowns. You just ignore them until they hit your exit. And even then, most of them rallied. But fortunately, not all of them hit my exit, and I was able to hang in there.
What about you, Moritz? How long term should we
exactly
be?
That is the interesting point here. What's the definition of long term, right? So 5 minutes is extremely long term to a high frequency trader, and 5 minutes is nothing to us. It used to be that, at least I remember that, like, trading 100 days is long term. That certainly isn't long term to me anymore. But I must say, like, I'm trading it's kind of like the 18-month type of thing, but it's like a 300-day exposure to a 300-day window. Yeah, I have that in there, but it's in the eye of the observer whether that's long term or not. Maybe that's now medium term. I really don't know. So it depends on who you speak to. There's a point to be made to have a 400-day or maybe a 500-day exposure.
I've read articles of some of the famous CTAs, and they would start describing certain charts and trades, and gold. Gold was one of them, and this person started describing being long gold, and I'm like, oh my gracious, they're longer term than me, and they were long gold or short gold or whatever. But they threw in the vol targeting. So we all see the same issue here, and that is you've got to be long-term. You're going to get knocked out, and as soon as you get knocked out, the odds are you're going to have to buy it again, and that's the cost of trend following. You get out, so glad I got out. I solved all these problems by getting flat. Oops, now I got to buy it again. Yeah, went right back up. Got out too quickly. Even if you have a super-duper long-term, you're going to have to buy it again. It's going to rally to the highs sometimes. And then what is the solution? I'm going to change my exit based upon the size of the profit. I'm going to change my exit based upon the vol. All of these nuances, all of these degrees of freedom are hammering on robustness when the simple system is waiting for the 100-day low, the 150-day low, the 200-day low, and it's just so painful. And I mean, this is honestly where we're all at. We're all making these different choices, and we're believing in what we've chosen. Although sometimes I say, darn, I don't know if my confidence is waning. It's a tough business.
It is a damn tough business for sure, without a doubt. Well, we appreciate the question, Sam, as you can tell. We love diving into some of these points. Now, here's a question that certainly have you in mind, Jerry. This is from Scott. He starts out by saying, I'm a long-term listener of the podcast. Look forward to it every week. Appreciate that comment, Scott. I'm a trend following believer and have been for a while. When Jerry and the Turtles back in the 1980s, they did amazingly. Hang on, let me just start with it. When Jerry and the Turtles traded back in the 1980s, they did amazingly well for that period of time. And it seems to me that trend following is capable of eye-popping performance as long as someone could stomach a big drawdown, which no one seems to be able to do. My question, if you didn't have to worry about investors' psyche and didn't mind, say, a 75% drawdown, how well could a diversified portfolio do in a year if you let it rip 50% in a year, 100%, question mark. Love to know what you guys think the incredible upside might be. It's kind of a funny question because normally we don't really think too much about what the upside could be. We're more worried about what the downside could be. So,
yeah, well, we've said on the podcast, Moritz and I both, I believe, I think he backed me on this one. We're probably not too far off, but that the return is the drawdown is maybe at least twice as much as the return. So half of 75%, if he wants me to risk max drawdown of 75. I mean, it may not work out that way in the future, but I would say that maybe 30, 35 or 37.5 might be the limit. I wouldn't recommend it. What you can tolerate and what you're how macho you can be before you hit a 75% drawdown is probably not a good indication of how you're going to be feeling when you're actually down 75.
Plus, there's a bit of math here, right? Because if you're down 50%, you have to make 100% to get back to even, right? So you also have to be a little bit cognizant of that side of things. Plus, you have to be, I mean, one of the things that we've learned from day one in trend following school is you have to be there, or you have to survive to play another day, right? And so if your account is down 75%, but you actually need 40% margin, I mean, if you have that kind of leverage, you probably use 30-40% margin. So if you're down 75%, I mean, you have to trade a lot smaller than what you would normally do. So I don't think it's a matter, Scott, if I can address this specifically, it's not a matter of really how much can I make in absolute terms. I mean, it's all relative to the risk you take. And there is all of these things that you can read about, about volatility drag and so on and so forth, that if you get so far away from your all-time high, I mean, it just takes that much longer to get back. So as Jerry said, I wouldn't recommend trying to shoot for the stars. I would much rather make sure you're here every single day for the next 50 years to play the trends and take advantage of them. And I don't think a 75 and trading with that amount of leverage would be a good idea. Also from the point of view that we have to always be aware that something that we have not seen in the data yet could happen. And it is not completely for fun that we always say, or a lot of people say, I don't know that we always say it, but a lot of people say that your worst drawdown is always in front of you.
That's the point, exactly. And, I've never really thought about it in the way of if I'm ready to accept X drawdown, then I'm looking to make Y or 2X or 3X% return. I never thought about it that way. But let's, if you want to have a look at some numbers, I mean, say you had a one Sharpe ratio trend following system, which is a fantastic trend following system. If you ask me, I like a one Sharpe ratio system, right? But for the ease of the calculations here on the podcast, let's use one. If you traded that at 20 vol, then your expected rate of return is 20% per year, right? And my experience, just looking at history and everything you said about the worst drawdown being ahead of you, Niels, I agree with that totally. But with a 20% vol system, that's your standard deviation. I think, looking at the historical numbers, you should expect between 2.5, maybe even 3 standard deviations of a drawdown there, right? So it definitely gets you into the 50% range. So there you have your 50% drawdown, definitely with a 20% vol system, making 20% per year, not 150. There may be a 150% year in there. Yeah, for sure. One of those years, not for sure, but it could be, right? We've seen this. Some of those guys made this in 2008, 2009. But you will have some other years which are brutally bad.
As Jerry often reminds us, we have always to look at the S&P, a 15 vol strategy with an 8% return and a 54% drawdown. So,
yeah, I mean, I wrote that down a few minutes ago when one of you guys made a comment because these returns that the long S&P gets, they deserve those returns. It's the riskiest thing on the planet. Never get out. And 50+% drawdown is just what's been in history. It was much higher in the NASDAQ and some of the other indices. So they deserve that little paltry 8% with a 50-some% drawdown. We're trying to do something much different, give you 8% with a 16% drawdown, 20% drawdown. That's what our goal is. You just have to sort of buy into the idea that cotton, coffee, cocoa, sugar, corn, wheat, and beans are part of the portfolio, and shorts are part of it, and they don't track the S&P, and they can go through periods where they don't do as well as the S&P.
Which is why, coming back to your point earlier, Jerry, about David Drews and his article about, reassuringly volatile, that risk and volatility is not the same. And this is why it's also kind of frustrating, even after all these years having done this, that people still look at us as the riskiest thing that they could choose, when in fact the numbers doesn't suggest that. It's just that it happens more frequently for us that we are in a drawdown of a reasonable size. People who only look at equity, or people who prefer equities, they forget that the Nasdaq went down 80%. They forget that S&P went down 54%. I mean, and this has happened in just in the last 15 to 20 years. I mean, it's so.
Well, when we get back to the normal markets and normal performance, they'll forget for us as well. So I'm all for forgetting. But he brought up the turtles, and I just thought about how it's a different sort of game now than the 80s. And so now it is, we described it accurately of how it would work. So if you want me to, how much can I make if you give me a 75% drawdown? Given the need to trade long term, the first need of your system, the first requirement is it needs to make money. Now let's move forward. How do we make it better? How do we make it more robust? So in order to make money, I've got to trade long term. My drawdown is going to be at least twice my average or annual return. Now, back in the 80s, it was much different. We traded very short term, and all of the drawdown, and it was profitable. So it's profitable, short term, and so the massive drawdown, the 4 years of the turtle program, we probably averaged 200%. The drawdown was totally due to leverage. I mean, so was the 200%, right? But moderate leverage these days will get you a 75% drawdown or a really uncomfortable drawdown because we have to trade so long term and sit through more choppiness and more drawdown. So it's a different ball game, much different than the past. Nothing survived nothing about the turtle systems has survived except, I would say, the money management and things like that. But
the philosophy for sure has survived, right? Letting winners run and cutting losses. When you say short term, Jerry, I'm curious. Maybe I didn't read up on that in all the turtle books that I've come across. But when you say short term back then, I mean, what do you mean? I mean, how short is short?
Well, I'll tell you, since it's in the public domain, books and websites. But System 1 was 25 to 20-day high. Sell at the 20-day low, 2 ATR, or maybe smaller sometimes, 2 ATR stop loss. System 2, I think, was 40 days higher, 20 days lower, 2 ATR stop loss.
Yeah.
I could be corrected because everybody knows these numbers.
Sure.
I might have forgotten it, but I think that's kind of what it was. So compare that now to 200 days higher, 175 days lower.
Yeah, you look like a high frequency trader back then.
You leverage it up, you get a 20 ATR move. A 20 ATR move was the golden move. That was it. 20 ATRs. You get 20 ATRs, that may take you a few weeks or a couple of months. My back test is making all of its money in 1.5 year, 2.5 year trends. Yeah. So it's way different. And I think I've come to this conclusion that, listening to other turtles and mentors talk about the way they trade now is that I think I misinterpreted and I got off track on a lot of what that program was all about. And I don't think it was about trend following. It was about research and using math and computers to figure out what worked. At that time, trend following worked. And that sort of the parameters were probably, longer term parameters would probably be unacceptable then and now. And it never was about, I took off on trend following as this down in the wool trend follower, but I don't think that's what it was about. I misinterpreted that. I think it was about evolving, and maybe you trend follow today, maybe you don't later. You come up with other ways of doing it, 5-day holding periods, 10-day holding periods. I don't know, but I don't think the bottom line was systematic and using research and making money, not necessarily trend following. That's, I think, something. So I like to say that I haven't changed very much, except the parameters, but I may have changed away from the original philosophy more than anyone else.
I mean, I think it's interesting you mentioned that, and I'm sure people might be shocked if now that they hear you say that maybe the Turtle program wasn't about trend following, which I think is a great. I'm sure that's going to be a great quote in the tweets for next week. But it kind of ties in a little bit with the fact that if you look at one of the two mentors of the program, namely Bill Eckhart, he did not go and become a long-term trend follower. I mean, in fact, he probably, went even shorter than the original set of rules in the way he trades. But he kept some of these philosophies, cut your losses, let your winners run, and money management, as you rightly say. So maybe you weren't off when you now say that, thinking back of it, maybe the Turtle program wasn't about trend following per se, even though all the rules you were taught can be applied within a trend following system. But maybe it was about all the discipline, the do the research, do the work, etc., and that was what Richard Dennis really taught you, along with Bill, of course. But that's what the legacy is.
Yeah, I'm gonna backtrack because you frightened me there with saying this is going to be a big quote, because I don't want to have a big quote. There's 20 turtles and there's 20 different opinions about everything.
Sure.
But yeah, I think that's not I shouldn't have said it that way.
Okay.
The turtles were about trend following, absolutely. But being in that program was not about here and now. It was about how are you going to survive and evolve, because the markets change and they evolve, and you need to be prepared to have a long career and figure out in the future what you should be doing, and that should be centered around these basic principles and money management and backtest. And so evolving away from trend following is absolutely a possibility, although obviously for those 4 years it was all trend following. So and so I wasn't willing to evolve too much other than maybe just being longer term.
Sure. Cool. All right. Last question of the week. This is from Bruno. And I think Bruno, because I saw the question while we were talking just before, and I think it kind of touches upon a lot of the things we've talked about today. So let's see if we can't wrap this up into a nice, concise answer for you, Bruno. And Bruno is actually a systematic trader. It doesn't come across necessarily from the question, but I know that because I had to ask him to be sure. He says, I love to hear you guys talk more about trading discipline, handling pullbacks, and letting profits run. The main problem in my trading is that I don't handle pullbacks within a profitable trade well, and I often take profits too soon. Any suggestions on how to overcome those issues? It has been really hurting my performance, as I have left a lot of profits on the table by trying to pick top or bottoms on a profitable trade. I know what I'm doing wrong, but I just find myself making rash decisions as I see a good profit decreasing rapidly. So I think that really synthesizes the issue that we've been talking about today in many ways. So I'm sure you're not going to hear anything completely new, Bruno, but let's just go around and give you a little bit of feedback on this. Moritz, you've been quiet for a while, so just to make sure that the Austrian mountain air hasn't completely taken it all out of you.
Yeah, it's kind of fresh up here. It's 1,600 meters of altitude, so it keeps me fresh. But I like this question. I can give, it's just a personal recommendation. Maybe you guys have different things and different ways to look at this, but I'm willing to share what helped me because it is difficult and dangerous. But what helped me is to not look at the markets all the time. I used to be, when I started, because the things are moving, right? It's so exciting. It's so interesting. Gold's moving higher, oil's moving higher, this is moving lower, that is moving up. It's so interesting to look at that and the velocity of the moves and what's triggering it. But at the end of the day, that's not really important. It's not important at all. And so the way I go about it is, still go about it that way today. Sometimes I do look at the markets, but really I do it at the end of the day when the markets are closed. Or maybe I don't even look at the market every day, but only every second day, and not at every market that I have in the portfolio, right? So it's kind of like when earlier today we said that, gold was going to 1,400. Well, I didn't really see it today when it happened. I saw that, half an hour before we started to speak when, I looked at the market, like I had a real quick look at the things. But, it kind of like keeps me away from pulling the trigger. Sometimes when I look at this thing, the markets are closed already. I can't force anything anyways, right? So that is the cure for me is, there's no point looking at 5-minute bars and following the markets intraday.
Jerry, what do you think?
Yeah, I mean, I agree, and I think the most, you need to follow your system, but then you need to make sure your system isn't too short term. So put those two together. Sorry, I can't help you if you're not going to follow the system. And I've already told you need to be longer term and look at those weekly charts and see what parameter keeps getting you knocked out too quickly, and only to see the market go to new highs. And so keep going, keep expanding that. I read this book, Taleb book, Fooled by Randomness, and that's like a little basket case at the time when it is related to being disciplined and following my systems and watching the markets. And somewhere in that book, he says, like, don't look at the markets. I mean, I just took that as license right then and there. Oh my gosh, that's fantastic. Don't look at the daily markets. Don't follow. Don't be a tape reader. And so I haven't looked at the markets very much since then, nor have I really looked at daily performance numbers since then. So I think that's how I highly recommend that. I think that people have these systems. They hear us talk. They hear everyone tell them exactly what to do. Follow the system. When the exit gets hit, that's when you get out. I mean, people will ask you a dozen times, and when you tell them that, well, when else do you get out? You don't. You just get out when the exit gets hit. Your stop loss, if you have one, or your trailing stop. If you have an override that says on a massive monster profit, when I'm about ready, it looks like to give back all of it back because my trailing stop is so far away, I'm going to have some sort of override. Okay, whatever. Good luck with that. It's really difficult to pull that off. But I get George sent me these quotes, and he wanted my comments on all these quotes from this one guy, and he's like, and one of the quotes is, if the stock doesn't act as expected, that's a major red flag. And I'm like, no, follow the system. You've got get out when the exit rules are met. Not acting as expected is some sort of discretionary thought. Until your exit is elected, you have no thoughts. You have nothing to do. You have nothing to think about. And there's no such thing as the market not acting as expected. It's just so, I know it's a brutal thing to say, but just follow your entries and exits. There's nothing else going on here. Smart people get involved in this type of thing, and they're like, well, where do you go from here? And the answer is you don't go anywhere. Get into another field. If you're not rewarded intellectually by following these trends with very few variables, then find something else to do. Get into short-term AI, short-term trading or something. But I think for the vast majority of us, the worst that's going to be ever said about us was we had massive drawdowns, and we ended up making pretty good money. And you just got to embrace that and accept that.
Yeah, well said, both of you guys. Let me add just a couple of things for you, Bruno. I actually had replied to you by email, and more or less exactly what Moritz and Jerry has said about, don't look at the markets every day all the time and spend your time doing something different. But one thing that springs to mind when I read your email again is actually, I think you might be over trading. I mean, I think if I think that the attraction for you to try and fiddle with your system like that and try and pick tops and bottoms and all of that. I think it's because the P&L has too much of an impact on you emotionally. So I would also suggest maybe just take it down a notch, as you've heard Jerry, Moritz, and I say many times. I mean, over trading is not a good thing. So on top of all the other stuff, I would do that. And as Jerry says, I mean, once you've done your back test, once you're comfortable with it, You need to learn to love that. I mean, you need to learn to love your systems, your losses, because you believe in the long-term projection. But I will also say, and I know this is maybe a weird thing to say to someone like you who loves to trade, but sometimes I don't know that building your own trend following system is the best thing in the world to do. I mean, sometimes I think it's better for people to go and find a trend follower to do it for you, and then go and do something else that you love to do. Life is short, and there's no point in being emotionally challenged every day just to pursue this, because there are a lot of good people out there who can do it for you, and then you can go and do something else. Anyways, enough said about that. Thank you, all of you, Bruno, Scott, Sam, and Mike, for your questions. We love them. Keep them coming. To send them to info@toptradersunplugged.com. And by the way, one thing I will more say to you as well, Bruno, that I just forgot. You're in a bit of luck, because when we talk about people who can really withstand volatility and drawdowns in this game, the next week's guest, he is phenomenal to talk about this, because he's been in the game for a very long time, great trend follower, and a good friend, and that is Salem Abraham. So he's going to be on the show next weekend, and I'm sure there's going to be some golden nuggets for you on this topic again next week. But keep the questions coming for Salem next week as well, so that we can really dive into that. Let me run through this week's performance. Of course, as usual, it is as of Thursday evening, so that would be June 20th. But it's so far been a pretty solid year. Beta 50 is up 3.05, up 6.32 for the year. SocGen CTA Index up 3.35, up 5.64 for the year. SocGen Trend Index up a whopping 4.29 for the month, up 9.05 for the year. SocGen Short-Term Traders Index up 1.67, almost flat for the year now, slightly down. And the Bridge Alternatives up 3.19 for the month of June, up 7.13%. Although I will say, I'm pretty sure we're going to give back a little bit today, Friday the 21st of June. So, any final thoughts from you, Moritz, up in the mountains? From you, Jerry, in the sunny state of Florida? Any final thoughts?
Not going to yodel anything, but happy trading, and looking forward to speaking with Salem next week.
Yeah,
Absolutely.
Salem's really funny, really insightful, and really smart. And so it'll be a great podcast.
It certainly will be. So, and of course, as always, if you like what you're hearing, then please help other people discover the show by leaving us a rating and review, ideally 5 stars if you think we deserve it. And please share these episodes with your friends and like-minded colleagues. We really do appreciate it, and it does help a lot. So I'll continue to ask you for this little favor. Take a few minutes out to do so. From Jerry, Moritz, and me, thank you so much for listening, and we look forward to being back with you on the next episode of The Systematic Investor, as mentioned, with our friend Salem Abraham. And in the meantime, have a great week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.